start. I think we're just after 9:30. Hopefully everyone can hear me. My name is Stephen Bell. I'm a director in the corporate finance department here at Pierce Chartered Accountants. I suppose over the past 20 to 25 years, I've worked within corporate finance as a profession, as a specialisation, and generally advised people at critical times in their business life cycle. So we deal with people at transformational times in their business life, whether it's buying a business, selling a business, raising money. So hopefully with myself and the team that I work with, we've got lots of practical experience to help you find your way to a successful exit. My personal experience, I've spent time as an equity investor for one of the large national investment funds. So I can advise you on the kind of criteria that investors look for in businesses. The department itself is headed up by Kevin Stephen, who has extensive experience of working with one of the national banks in their structured finance team. So he headed up one of the region's structured finance teams. So we've got the ability to look at all aspects of funding. And alongside that, in the last 25 years, as we say, we've done lots of acquisitions and disposals. So hopefully we can bring some pragmatic experience to support your business. So in terms of what I'd like to talk about today, it's really a run through of the sales process, how we can support you, and rather than giving you the answers, maybe giving you some questions to ask yourself and your advisors as to whether or not you're doing what you can to maximise your current value and potential value on exit. So what would that be? I suppose it's planning your current remuneration in a tax efficient way, looking at your long-term investment objectives. Second point would be maybe considering factors that would affect the value that an acquirer would pay. Some things to think about, what you may and may not be able to influence. Third point I'd really like to touch on is deal structures. What you can expect when you are exiting a business, from cash, from deferred, from earn-outs, from retained equity. What each of those, the implication for each of those on you as a vendor. And the last point is really how we go about adding value to a disposal process by targeting the right type of acquirers. So in terms of pre-sale planning, the first point is really looking at your current financial situation. Now, we can assist with this in terms of headline tax planning, but essentially this would be engaging an independent financial advisor to look at your current asset scenario, looking at what you want to achieve in retirement and considering a potential sale of the business. Do you have the assets to achieve that? Now, as a firm, Pierce doesn't provide that direct service. We do partner with a firm, Pareto Financial Planning. Why do we partner with them? Well, they're local based. They are around £1 billion under advice. So they're a significant player in the sector, and they have 20 professional advisors. Now, what would they do? They would do a personal cash flow for you. They'd look at your current assets, what you want to achieve, and come up with a plan to help you deliver that so you can have a successful retirement. On top of that, as a firm, we would be able to help you with maximising your current value, extracting cash in a very tax efficient way. Now, recently, lots of people have incorporated businesses. The benefits of incorporation are probably a little bit less now than they used to be, but people taking minimal salaries, avoiding national or reducing national insurance, and taking dividends. Dividends are more tax efficient than direct salary. As an example, as to what we do, we've recently been introduced to a new client. They are a two-firm consultancy business. Historically, they've traded as a partnership, and the profits that the individuals make are significant six-figure profits. Their previous advisor has structured that as a partnership. Why was that tax inefficient? Well, they're paying personal tax on all the profits, irrespective of whether they need that. We introduced them to our tax director, Dominic Ball, and he's introduced a structure that gives them the ability to invest that money that's not required in a very tax-efficient corporate tax shield. There is an element of significant tax planning surrounding that, but that has a monumental saving for tax without doing anything really technical or detailed. It's just providing the right advice. And that allows them to build up that financial nest egg in a tax-efficient structure. The second point is to consider, are your shares in the company held in an efficient way? Obviously, people are aware of business asset property relief, used to be entrepreneurs relief. Obviously, once again, that's less valuable now than it used to be, but entrepreneurs can still earn £1 million capital gain on a business asset and only pay 10%. Now, that's a lifetime allowance. We have a client at the minute that we've been introduced to. We're in a sales process for that. Historically, their accountant has structured them where it's two family shareholders. One of the family shareholders owns their shares along with their wife. The other one owns them personally. What's the implication for this? Well, we're potentially selling the business for around £5 million. The sibling, the brother that owns the shares with his wife, they will both qualify for entrepreneurs relief and therefore pay £2 million worth of the gain at 10%. The brother that owns them all personally will only get £1 million of tax at 10%. So with some planning, historically, that brother has lost out on £100,000 in tax. Now, we don't know the implications behind it, but it's just simple things that you can look at. And can your shares be held by your children? They have £1 million entrepreneurs relief. So it's just thinking about structuring. Are my shares held by the right people to maximise the available reliefs? The next one is a potential pitfall where is your business a trading business? Entrepreneurs relief is only available for trading businesses. Now, I sat with a client yesterday. It's new to the firm. They're thinking about selling the business. They have significant investment property assets held in the trading business. Now, they've loaned the money to separate companies, but those assets are still held on the balance sheet as loans. My comment to them was, you're potentially going to lose entrepreneurs relief. Now, I'm not a tax expert. I'm not a tax planner, but I know that could prejudice the claim for entrepreneurs relief. And if they sell the business to shareholders for more than £2 million, they will lose out on that 10% tax rate. So simple tax planning. We've recently restructured a business in a similar circumstance that moves those assets out of the trading entity. So it's questions to be asking your advisors is, are they structuring your business in the right way to maximise value and to mitigate future tax? The next point I'd really like to just touch on is things to consider when you're approaching a disposal and the implications that it can have on either the value or the structure of the transaction. Now, the first point is the business reliant on you as an individual? If it is reliant on you, that can have an impact on either reducing the value or alternatively meaning that the acquirer will delay the payment of consideration. Why would they do that? Well, because there's an inherent risk in you taking cash off the table and walking away because you've obtained financial security. They've bought a business that's dependent on you, and therefore there is an inherent risk. Now, I've recently advised a client where It was a consultancy business, a 5-people consultancy business, but over 20 years. The entrepreneur had built the business up. It was still heavily dependent upon him. And in the initial conversations, I advised him that it was unlikely that any acquirer would pay him 90% of the consideration on completion. You know, the discussions I ended up having with potential acquirers, and these were large international businesses that had cash resources, was, you know, they would maybe pay, 60, 65% on completion. The rest was going to be paid over an extended period. Why did they do that? Because that meant that they had an extended period to secure the business, to secure the transfer of the relationships. The vendor had a great opportunity to benefit for the future with the earn-out mechanism, but ultimately that was just the nature of that business. It was dependent upon him. So the deal structure reflected that. The next one is, have you got the financial controls? These have to be appropriate. I'm not asking you to prepare full detailed management accounts every month. But when you come to sell the business, it will have a direct impact on how an acquirer perceives your business. I advised on a large waste management business on 2 acquisitions, both relatively small, 3 or 4 million turnover, neither prepared monthly management accounts. It was clear when we looked at the financial statements that there were significant adjustments at the year end. What was the implication there? Well, the implication was that we couldn't rely on the financial information being produced. How did we reflect that? Well, our deal structure was we would pay 65, 70% of the value on completion, and the rest was based on an earn-out on performance. Why did we structure it like that? Because we had a risk. There was a risk in buying that business because we couldn't rely on the financial information. So it's really clear that you have robust financial controls. I appreciate that many entrepreneurs run businesses and they have an inherent knowledge of what's happening. But you've got to take a step back and think, I know what's happening, but can I show to an acquirer that I've got control and that the information that I'm presenting to them is robust and accurate? Third thing to consider is, do you have any key staff? On a disposal, what would their attitude be if there's a new acquirer coming in? Could they walk away from the business if there is a chance of that has an implication for you as a vendor? Because an acquirer would look at that and look at, once again, there's an inherent risk that the business that they're buying may not be the same in 6 months' time. So consider some long-term incentive plans. Whether that's share schemes, whether that's bonus schemes, whether as part of the sale process, you can offer them a bonus for staying with the business for 6 to 12 months. Now, that's not particularly tax efficient, but it helps you deliver value and drive value to the business and to your consideration. The fourth one is one that I think lots of entrepreneurs and business owners will consider, is non-trading expenses that go through the business. Now, I'm not here to comment or criticise or pass judgment on whether people do or don't. All I know is that when we come to sell, if we're supporting you through the process, if we're engaged to sell your business, we will be presenting information to the acquirer that reflects the true trading costs of the business. So if you have private vehicles going through, if you have family mobile phones going through, if you employ your siblings or your children in the business, but they don't do a commercial job, we would say to the acquirer, they're not true costs of the business and therefore the profits should be higher. Now, we've got to make the argument, and we've got to make the robust argument to make sure that the acquirer accepts that. There is an implication, though, that we bought a business a few years ago where it was presented to us that the vendor was running a significant number of very expensive private vehicles through the business. These were, I think there was a Rolls Royce, there was an AMG Mercedes. So, the vendor liked his cars. which was fantastic for him. It was a very profitable business. We accepted that they were non-trading costs, that the insurance cost was overstated, the motor running costs were overstated. So we allowed them to adjust the profits. We agreed with the adjusted profits. But the other implication was they'd underdeclared taxation for a number of years, and therefore we were under an obligation to report that as part of the sales process. The implication of that was the vendor had a significant tax bill to pay, which he paid, fair enough. The implication for us advising my client buying it was it increased the risk of a revenue investigation, following the business. And then all of a sudden, it wouldn't just be the business that we acquired that would be investigated. It would potentially extend to the whole group. So it's things to consider, planning opportunities to consider when you take a step back and say, yes, I can take lots of money out tax-free or tax efficiently, but consider if you're coming towards a sale, the implications that it could have in the sales process. The final point, just as maybe a quick question, is, are you reliant on client relationships? Do you have fixed term contracts with your clients? Now, I have a specific opinion on fixed term contracts. I think people focus too much on that. If you look at suppliers to the supermarkets, there are no contracts. They could stop supplying the business the next day. And people get over that and value a business on the continued profitability because of the strength of the relationship. All of a sudden, as soon as you include a fixed term contract, people focus on that and say, oh, well, it's for renewal in 3 years' time. There's some problem potentially about it being renewed. We had a business that supplied food under the Weight Watchers brand, and it was a 3-year contract. The buyer was focusing on, well, there's a risk that it may not be renewed in 3 years' time. They'd ignored the fact that this contract had been renewed 4 times previously. So there was an exceptional client relationship there, strength of client relationship. And also it may not be a negative. We bought a business that for a client that was a high-tech engineering business. 90% of its sales went to one of the major Formula One manufacturers into their engines. How did we get comfortable that was a robust relationship? Well, the manufacturer of the engine didn't dual source. They only purchased products from our client, the client that we bought. And therefore, we knew that we were a fundamental part of their supply chain. If we didn't supply their products on time to the right specification, one of the leading car manufacturers on the Formula One grid wouldn't be running their cars. So we got comfortable that 90% reliance was a strong relationship and valued the business on that basis. So client concentrations may not always be a negative, but it's just things to consider. When we come to look to sell a business, it's how we present that story. It's getting the story right when you present it for a sale. And that's why advisors like ourselves, who've been doing it for a while, can guide you on this, what people look for, because we've advised on acquisitions and disposals. The next point I really just want to touch on is potential deal structures. This can be very emotive for clients. It's a risk and reward. Who takes the risk, who gets the reward? Obviously, as a vendor selling a business, you'd want to maximize the cash that you get on completion. Why? Because it's security. It's not at risk. You can invest it, you can take it forward. We can introduce you to Pareto again, and they can take you through and invest the money to give you a nice, successful, comfortable retirement. But that's not always the case. Why not? Because there are risks in buying businesses. That everything that we've told people through the process may not be purely accurate. Things may change. Client relationships may change. Key employees may leave. The business may change. The business may develop and grow. Or light and heat prices, oil and gas prices at the moment, they've had a fundamental effect on the mergers and acquisitions market, just because things are more challenging. So if you're not going to get cash on completion, how would you get it? Well, the next step down would be deferred consideration. What's deferred consideration? It's a guaranteed amount of money. It's paid over a period of time. It's not dependent upon future performance. It's more risky than cash on the basis that you are dependent on the business being there for a period of time to pay it. You know, you can have security over that, but if the underlying business goes bust, the security is worthless. As an advisor, we will work with you to assess the risk of that deferred consideration. You know, we're selling a business at the minute where the deferred consideration is defined by the financial position of the buying group. You know, they are only allowed to pay 4 times profits on completion. So the remainder of the deal is structured in terms of deferred. Are they a good risk? Well, they've acquired 11 businesses in the past few years. They've got a significant financial backer, and that's been publicly reported. So we can sit down with our clients and say, we've assessed it, we've done our research, this is the financial situation, and therefore there's a lower risk in that deferred consideration. It's just you have to wait for a period of time. Probably the red light that everyone gets excited about is an earnout. You know, vendors don't like earnouts. If I was buying a business, I like earnouts. Why is that? Because they're higher risk. You know, there's a chance that it may not be paid just because it's dependent upon the future performance of the business. They can be complicated to structure, but as an experienced advisor, we know what does work and what doesn't work, what is complicated and what is easy to structure. Really, and why would we structure an earnout? Well, it's because, as we said before, the risk. Is there a reliance on certain clients? Is there a reliance on contracts being renewed? Is there sensitivity in the financial numbers? Maybe the financial numbers, the financial accounts aren't robust. We can't rely on that information. So it's just things that you can potentially affect that earnout situation by improving the financial results, improving the financial structure reporting mechanism. You know, we're currently working with a client where there's an element of cash, deferred and earnout. The cash is 4 times profits at completion. The deferred is paid over 2 years. The earnout, it's calculated over 1 year, you know, and we've sat down with the client and worked out that by the time we do the transaction in 3 months' time, they'll have already worked 6 months into that earnout period. So we can sit down with the client and say, yes, it's an earnout, yes, it's risky, just by the nature of it, but we can quantify the value of that earnout fairly early in the earnout period. So the client has now become comfortable that whilst there is a risk, it isn't a high risk. You know, what's the benefit of that? Well, we've brought our experience and our research and our assessment of the deal to help the client understand the nature of it, you know, and the risks associated with it, and got them comfortable with it. The final point is retained equity. You know, this isn't appropriate for all transactions. We've got a transaction at the minute where there's different age groups in the shareholders. You know, one is mid-60s, he's looking to retire. The 2 other shareholders are late 30s, early 40s. You know, they want to stay with the business for another 10 years or so. Excuse me. So there's an opportunity there of an acquirer coming in and letting them retain equity, you know, giving them the opportunity to have a second bite at the cherry. Now, it's not, as I say, it's not appropriate for every situation, but it's something to consider. And as an advisor, if it's appropriate, we'll walk you through the risks and the rewards, the pros and cons. So really what I'm saying is in deal structuring is there is no scientific way of working this out. It's down to negotiation. From my point of view as an advisor, you know, I would use my experience, you know, the experience that we've got here within the team, to structure something that's appropriate for you. You know, we wouldn't want you to walk into something that is unknown and that is unadvised. So, you know, I would say the main thing, whether it's Pierce Chartered, you know, Pierce Corporate Finance or anyone else, don't immediately walk away from an earn-out, because it could be very fortunate for you. You know, it could be very valuable for you if there's no cap on it, if there's an upside. So consider all things, but use your financial advisor, use your corporate finance advisor to understand the implications. The next point is, how would we target buyers? You know, what value do we add in the process? So, you know, we have a process, we have databases, we would use our network. So we're not a broker. You know, we know that there are disposal firms out there that will say they have a database of 20,000 contacts, which is fantastic. You know, that's a great business model for them. My comment there would be, you've probably got 19,980 clients on their database that wouldn't be interested in your business and wouldn't have the ability to buy your business. You know, we aim to be more sniper than shotgun. How do we do that? Well, we would want to target maybe the 15 to 20 companies that have the ability to buy your business. How would we do that? Well, we'd work with you and look at, you know, who are your competitors? You know, what is your knowledge in the sector to be able to target people that you think would have an appetite to buy you? You know, why would they buy you? But we wouldn't just take that for granted. You know, we would do our research and look at, in all the targets that we come up with, do they have the financial security to buy you? You know, have they got financial backing from a reputable investor? Do they have cash on the balance sheet? Have they bought companies and they bought businesses before? If they've bought businesses before, who have they used to advise them? You know, are they credible advisors? Have they delivered the deal successfully? You know, have we got the ability to speak to the companies that they've bought and found out if they're honourable, if they do the deal, if they do the deal say they're going to do? You know, so that's part of our process, is that deep research into these targets. We also have a network of corporate acquirers. Now, these are businesses that may not be operating in your sector, but we're aware through our previous discussions with them that they're active in buying. They're bringing together a conglomerate of businesses. You know, there may be opportunities for them to secure synergies across a number of different sectors through either buying groups or similar customer bases or similar supply networks. You know, we've got that network of people and we will have those discussions with them, and they're pre-qualified because we know they're reputable people by the fact that they're on our network. The next point is maybe a management buyout. You know, it's not for everybody. You know, you talk to vendors about management buyouts and the first comment they would make is, well, they wouldn't be able to afford it. In reality, a management team probably has to invest a significant sum. What's a significant sum? A general rule of thumb is 1 year's salary. So the deal can be structured to allow a management buyout team to buy the business. Why would you do the management buyout? Because it's easier for you as a vendor. It's less onerous in the legal process. But as I say, it's not for everybody. So what is our skill? Well, our skill is, you know, the ability to deliver a deal. How we do we deliver the deal? We identify and pre-qualify the people who have the ability to do the deal and have got a reputation of buying businesses. We also try to identify the non-unusual suspects. You know, people that maybe aren't known to you. You know, we have networks nationally, we have networks internationally. You know, I've been speaking this morning to a buying group based in Germany. They have connections with acquisitive companies throughout Europe. They've introduced me to 2 potential buyers for one of my clients. So we're networks like that. And they pre-qualify the buyer because they wouldn't be acting with them otherwise. So our aim is to create a competitive environment. You know, it's not to have 50 people come and visit your business. It's to identify those limited number of people that have a real appetite to buy and create that competitive environment, because then that improves the value. That increases the value that we can deliver for your business. So I suppose just in summary, hopefully that's raised a few questions for you to ask yourself and your advisors. Are you doing what you need to do? And this is sometimes where you get the difference of opinion between buyers and sellers. Sellers want to be paid for what they've built. I had a client in here yesterday who's looking to sell his business, talking about years. Before that, we were unincorporated for 20 years. There's 45 years of history. That's fantastic. Really well done, great business. But that's not what a buyer will buy. Buyers will value and will structure a deal based on what they can do with the business. You've talked, I think at the minute Elon Musk is buying Twitter. He's not buying it for what it was, he's buying it for what he thinks he can deliver to it. There may be an element of it as ego trip, but it's our experience as advisors is being able to sit with you and talk to you about the fact that we've advised on acquisitions. We understand how acquirers value businesses, what they value as being important in a business, and therefore give you a real honest assessment of value and of ability to sell. We don't take on opportunities speculatively. We pre-qualify the work that we do. Why? Because we want a robust reputation as a quality corporate finance advisor. We don't want you telling your friends and colleagues that Pierce took my business on and couldn't sell it and they just took the fees. We want to deliver successful transactions, which is why we use our experience to deliver value for you and add value through the process. A little bit of an advertising opportunity for ourselves. If you go on our website, we do have a scorecard tool. It's 12 fairly straightforward questions, I think in 3 or 4 different sections, that gives you a score at the end in each section, out of 100%. How ready for sale is your business now? We're happy to have a no obligation meeting after that, after you've got your scorecard, to chat it through, to talk about some of these points that I've raised today. Because I understand that, I've been doing this business, this job for 25 years, and it's relatively straightforward for myself. But you haven't sold your business before, you'll only sell your business once. So, happy to have a no obligation meeting with yourselves, but please feel free to email and everything. So in summary, hopefully the last 30 minutes you've taken away some key questions to ask yourself, ask your advisors. I'm more than happy to meet up and chat through opportunities, and future planning, whether it's planning for significant time in the future. But, thank you for your time, and, happy to pick up questions either through email or now, if possible. So I don't think there's anyone who's got any questions at the moment. So yeah, as I say, there's my email address there. Happy to pick up questions through email or, as I say, arrange a meeting just to chat through. So thanks for your time this morning and have a good day.